now, some of the good news, okay? You can take deductions, all right? As long as they're legitimate business expenses. The big one I suggest you avoid is a home office, unless you're a tax professional and you know exactly how to do it. Home offices are a red flag for the IRS, all right? Be very careful. And the other big problem with having a home office is if you claim a home office, it becomes then commercial space. When you sell your house, you get hit with tax penalties you're not hit with. So it's really not a good idea to try taking a home office if you're ever planning to sell your house. Or, you know, does that make sense? Because the benefits for it being residential are pretty cool.
So basically, are you saying then that if you want to do an office, it's better to rent a commercial?
No, it's better to work from your house and just not claim it. That's probably the best thing to do. We claim ours, but we did it under the advice of a tax professional where we actually bought a house where we made the basement office space. And the basement has offices, and the basement is used for office work. And the family doesn't live down there. You know, we have an office in our basement. It is considered commercial space, so if we were to sell the house, we would not get, you know, when you sell your house, you get like you can just waive off the profit that you make on it and things like that. You can't do that if it's commercial. So we did it under very strict advice, and it's worked very well for us. But be really careful about home offices. You really probably don't want to consider that one until you're making enough money that it's your full-time thing, and then go talk to a tax professional. Don't talk to me, okay? Yes?
All that being said, what's the advantage to having a home office?
You deduct part of your living expenses, all of your like utilities and all those things are part of the necessary requirements to do your business. And so you get some cool deductions. They can be pretty substantial deductions. But because they can be pretty substantial deductions and because it's so easy to say, yeah, this room is my office, the IRS red flags those very quickly. So you have to have good records if you want to do that. The things that you can do that are very easy, you know, that are completely legit are things such as your computer. Warning, you need to depreciate it. You think I was going to forget that? I tried to do all this stuff on my own for a few years, and then I just broke down and got an accountant. If you need an accountant who knows writer sort of stuff, come to me. I've got an accountant, Eric Gurr, who kind of specializes in it. It has me and James Dashner and a bunch of the authors in the area because he now has done all this research on this stuff. But computers have to be depreciated. This means you can't take them as a deduction on the first year, except in special cases. Like last year, I think you could buy any amount of new equipment and deduct it immediately. There's like weird rules on things like this. But usually you have to depreciate, which means that you take like 1/5 of it one year, 1/5 the next year, 1/5 the next year, or something like that. Talk to your tax professional. But your computer, buying a new computer can be a pretty substantial deduction. Even if it's, you know, even if you're making, let's say you're making $1,000 a year, you're probably going to be able to deduct all this money and not have to worry about any of this. For instance, if your computer costs you $2,000, you bought a nice laptop and you're depreciating that over 4 years, that's half of your money that you're already deducting, right? Any of your flights and hotels when you go to a convention.
If they're used primarily
Yes.
for this.
For this, yeah, if you're going to a convention.
It's like 2 days for the convention and 7 days at Disneyland.
Yeah, but you can deduct the 2 days of the convention, correct?
Yes.
You just can't deduct the rest.
Yeah.
Your food, you can deduct half. Am I right on that?
Yes.
1/2 of your food, okay? When you're at a convention or something like that. When you're away from home, you can take half the food. There is also a standard deduction for a day out. I'm not sure how that one works.
Yeah.
Talk to your tax professional.
That one depends.
Yeah. But there is some sort of thing where you don't have to keep the receipts. They just say, a day of a person at a convention is this much in deduction from food. Just take that. Okay? So with these things, you can also deduct your ticket to the convention. Worldcon's like $200, okay? Your hotel is going to be probably, you're hopefully sharing with other people because you're new writers, but you're probably going to be paying like $50 a night. You're there for 3 nights. Your flight, you've already deducted this entire $1,000, okay? So this can be very useful for you to actually save you tax headaches and also save you tax burden.
But that's when you're actually making a good living.
That's when, no, this is if you're only making $1,000. That's a year, right? That's a year. Now, big warning, you can take a loss. It's a big red flag. But that means you can take and write off all these things if you have another income that you can use as, these are actually exemptions. These are not deductions, right? Yeah. Exemptions are different from deductions. But let's not go there. You can take all of this stuff as an exemption, but if you take a loss multiple years in a row, it's a big red flag, and talk to your tax professional before you do it. You see how I'm saying that a lot? I just don't want you guys to sue me. I'm also being recorded, so I want to be careful on this. But you can take a loss. Some authors I know strongly recommend taking the loss. But yeah. Okay? Question?
What does taking a loss mean?
That means that you spent $2,000 and you made $100. So you're going to take $1,900 of exemptions from your other income that you don't end up having to pay taxes on. Okay?
I can see why that would be a red flag.
Yes, it is a red flag. Yep, it's a big one. But if you're the type that keeps good records, you know, you can do this, and you might get audited. You will probably get audited if you do it a lot. But if you have good records, it can actually, you know, and you can prove, hey, I'm a writer, I'm not making a living at it. There's nothing wrong with not making a living at writing yet. Most businesses take a loss early in their business. You just have to, it means you have to be making good records. Now, I should probably explain the difference between exemptions and deductions. I'm going to get this one a little wrong, so tell me. But you can do all of this and then take the standard deduction that you normally take right now, that a lot of you probably do. Because these are from your business. They are something different. These are what you're doing to make money. Deductions are things where the government's like, we're going to be lenient on you because of your taxes for this and this and this, so we'll let you deduct this. You have a kid. We understand how hard it is that you have to pay for this kid. That's for the good of society. We give you a deduction because you have this kid, because we want to encourage you to help benefit society. These, as exemptions, are things that you're doing that you are actively trying to make money at, and you need to be able to do this stuff to make money. The argument for this, if you just think about it this way, let's say you spent $500,000 to make $550,000. That's a 10% earnings. That's actually in the business world okay. It's not fantastic. A lot of businesses are looking for much more than that, but that's okay. If you were charged your taxes even with deductions on the $550,000, you would end up owing like $70,000 maybe, just off the ballpark, and you only made $50,000. You see what I'm saying there? This is why you also, this is something we can say at BYU, I actually do not pay tithing on any of this. My bishop called me in when I first did this, and I was going to try doing it. He said, if you spent $500,000 and made $550,000 and owed $50,000 in tithing, what are you going to do? So that's why it's important to keep in your head what the difference between exemptions and deductions are. Sorry, this is boring, guys, but no one else is going to warn you of this stuff. Very smart thing to do is to get a business credit card. Spend only stuff for the business on that. If you are a member of the church, which I assume most of you are, you ask yourself, is this something I feel okay not paying tithing on? And if the answer is yes, because it is actively you trying to make money off of it, then you put it on the business card, and then you're going to try and claim it as an exemption. Or deduction, yeah.
Also, just a lot of people don't know this, especially students, but so Brandon talked about something called a standard deduction, which is taken off the income that you earn so that it reduces your tax burden. If you keep track of your tithing expenses, and if all of this plus your tithing exceeds the standard deduction, you get to deduct that instead.
Yeah. So anyway, there you are. There you are right here, okay? Questions on this complicated stuff?
Yes. How much is a tax professional?
How much is a tax professional? They are cheap. They are worth your money. Most of them charge by the form. For most of you, it'll be like $100, maybe $200 to do all of this, okay? BYU does it for free. I like having a tax professional because they will keep track. They will tell you when to pay your estimates. All of this stuff. The other thing is once you start having foreign sales, oh, does it get crazy? Okay. Oh, my phone is going off. Who is calling me? I have a bachelor party tonight that I'm organizing. It's probably, yes, someone going to that. Once you get foreign sales, okay, you'll have this in your records. Just, you can write this down. Most countries we have a tax treaty with. This means that they will try to charge you taxes on the money you make in France. Because we have a tax treaty with them, the money that you pay on that in France, you do not have to pay again here. Or you can convince France, I am paying my taxes here, and they will not deduct anything from it when they send the money to you, and then you pay it here. It works differently for different countries and different things like that. So, but that gets really complicated. Get a tax professional. I did it myself for a couple of years. Yeah. Get a tax professional. The first year we did it, and he's like, yeah. And he did it, and it cost us like $250 for all this stuff I've been doing. I was like, why didn't I do this earlier? This was so nice. And then he deducted himself, because there's certain amounts, because that you can deduct, right? For the business part of it, he could deduct. So it wasn't the whole thing, but yeah. So yeah. Yeah. Yeah, the tax, my accountant is worth every penny. So really, this stuff gets really complicated. All right.